Like many people, my fixed rate mortgage deal expires very soon, and so I'm left with firstly the shock of how much mortgage payments are going to go up, but also whether should I get a fixed rate deal or a variable tracker. And this question of which mortgage to get is quite difficult because at the moment there's a lot of conflicting signals about inflation and interest rates. I'm going to explain my thinking about why I'm going to risk a variable tracker mortgage and not a fixed rate. Now, the kind of choices that you're faced with at the moment are something like this. I'm with Barclays, and I can either go for a 2-year tracker, which is a base rate plus 0.5%, which is around 5% currently, or a 2-year fixed deal for about 4.8%. And a 5-year contract is a pretty similar deal. So in the short term, there's not much difference between a fixed rate and a variable tracker. But of course, over 2 years, interest rates could be significantly different. With a fixed rate, of course, you know exactly what you're going to get. And with a tracker, you could be either paying a lot more or hopefully paying less. So the first big advantage of a fixed rate is that you know exactly what you're going to be paying for. You can lock in the rate and you'll know what you'll pay for whether it's for the next 2, 5 or 10 years. Now, historically, a mortgage rate of 4.9% is pretty good. Back in the 1970s and 80s, even early 1990s, we had a period of really very high interest rates, reaching up to 15%. And in the early 1990s, this interest rate of 15% caused very substantial repossessions and a prolonged housing crash. And the first advantage of a fixed rate is that you avoid this kind of doomsday scenario. However, whilst 4.8% is good compared to the post-war period, it is relatively high compared to the past 15 years, the post-financial crash of 2007. Those who took out a tracker mortgage just before the financial crisis benefited from ultra-low interest rates. And I believe there are some products on the market in 2007 which offered base rates minus 0.5%, which meant a few lucky households were paying next to zero mortgage payments for a time period. So the big question really is, what will be the new normal for interest rates? Will it be like the 70s, 80s and 90s, or will it be much more like the 2010s with that period of very low interest rates? And to answer this question, we need to look at the prospect for inflation. And the first thing to be aware of is that central banks around the world have definitely been caught out by inflation. This is an interesting graph which shows the Bank of England's inflation forecast compared to what actually happened. And there's a very clear trend that inflation has been much higher than the Bank of England forecast. And this is why interest rates have risen so quickly and further than maybe predicted a few years ago. Last year, the Bank of England was still what we could call dovish, hoping that inflation would fall of its own accord. Their logic was understandable. The logic was that inflation was caused by temporary supply-side shocks, rising oil prices, rising gas prices, and this rise in energy prices also fed through into higher food prices too. But these supply-side shocks should in theory be temporary. But the bank is now concerned that this temporary inflation is leading to persistent inflation, which is becoming more embedded. Recently, the governor of the Bank of England admitted that the UK was suffering from a wage price spiral and that it will raise interest rates as far as necessary to get inflation down to 2%. So this announcement is very significant for interest rates and the housing market. It reflects two things. Firstly, that inflation has been much more stubborn than the bank predicted. And secondly, the bank is becoming much more hawkish in its willingness to raise interest rates and reduce inflation. It no longer is confident about inflation falling on its own accord. And reading that headline, it may make you want to go and fix your mortgage as soon as possible, because it definitely suggests interest rates could rise further. However, despite all this bad news on inflation and interest rates, I'm still prepared to gamble that interest rates will fall over the coming months and coming years. I'll explain my logic and you can decide whether you agree with me or not. Firstly, The bank is concerned that its failure to predict inflation correctly has dented its reputation, and I think it has to some extent. So there could be now a concern that it's lost its low inflation credibility, and this will make its job harder. So one reason I think for the hawkish tone is to try and convince people they are serious about reducing inflation. And they hope that this tone will moderate wage demands and price rises. But secondly, I feel that inflation is still being driven by temporary cost push factors. The bank's own analysis suggests there's virtually no excess demand causing inflation, which is quite unusual. But this is understandable given that economic growth in the UK has been very weak, with UK GDP amazingly still below pre-COVID levels. And given this climate of very weak economic growth, falling real wages, the rise in interest rates that we've seen are going to further weaken demand and economic growth. Now, whichever rate I choose, I am looking at paying an extra £160 a month on my primary mortgage balance. And that's only for a balance of £100,000. For people with a mortgage of £300,000, imagine how higher interest rates are going to reduce their disposable income. But what this means is that as the economy slows down because of the cost of interest rates, it will put downward pressure on inflation, and it will put pressure on the bank later in the year to reduce rates. Thirdly, gas and oil prices have fallen considerably since last summer's peak, and yet this fall has yet to be reflected in the consumer price index. But next month, the effect of rising gas prices will drop out of the consumer price index, and inflation should almost certainly fall to some extent. Fourthly, food inflation has been running at approximately 20%, a record level for the past few decades. However, global food prices have actually fallen in the past few months. But again, there's a time lag between this commodity prices falling and us noticing it in shops. One reason is that big companies buy food on fixed contracts. So as they make new contracts for the future, they will be dealing with substantially lower commodity prices. And supermarkets recently claimed that food prices will soon start to fall. Now you might say, I'll believe it when I see it. But if food prices fall or at least stop rising, it will help to bring the headline inflation rate down, and this will reduce pressure on higher interest rates. Fifthly, and this is quite important, I'm not actually convinced that there is a real wage price spiral that the Bank of England claims. The reason is quite simple. Real wages are falling rapidly, at historical record really. Nominal wage growth is in a sense high at around 6%, but that's still 4% less than inflation. There are so many strikes at the moment because workers do not have the bargaining power to demand higher wages to keep up with inflation. There really is no comparison with the 1970s or 80s when there was a more genuine wage price spiral. The sixth reason why I'm willing to gamble on a tracker mortgage is that across the developed world, we have seen a long-term decline in real interest rates. Interest rates have been steadily falling actually since the 13th century, but in recent decades, interest rates have fallen quite considerably. One reason suggested for this is demographics and secular stagnation. An ageing population has led to lower rates of economic growth, lower investment, and a glut of savings. And this has pushed down interest rates. A really good example is the case of Japan, once an economic powerhouse, but since the 1980s, it's seen much lower growth, low inflation, and low interest rates, close to zero. Now, the UK is not quite like Japan. Due to high immigration, we don't have the same demographic crunch. We have a relatively younger workforce. But even despite this immigration, there's still an ageing population, and this is likely to lead to lower rates and lower economic growth, like we've seen really since 2007. Because in the past 15 years, the UK's economic growth has really slowed down. It's been anemic, underpowered, well below the post-war trend rate. And given the climate of low growth and low productivity, I can't see interest rates rising too much because there's been no solution to the UK's growth problem. In fact, I'm worried that even interest rates of 4.5% are actually too much for the weakness of a UK economy, and it could lead to much slower economic growth and therefore a fall in inflation and interest rates. So this is why I am hopeful that interest rates will fall during the end of 2023 and 2024. I might regret getting a fixed rate of 5% when a tracker could in the future be falling to say 2.5%. However, having said all that, there is one caveat to this analysis, and that is given the political uncertainty, the geopolitical risks, there's always the possibility of a black swan event. Oil and gas prices have fallen, but there's no guarantee we couldn't have a renewed inflationary surge due to some unexpected geopolitical event. For example, suppose there was some issue with China over Taiwan. That could be devastating for global inflation. The Russian economy is a relatively small share of global GDP, at least compared to China. So we can imagine how any supply constraint from China would affect prices really quite a lot. Although, if we did have a supply disrupted from China, this may lead to lower growth and a recession too. So it's not immediately clear what would happen to interest rates. But the inflationary surge, which was unexpected in 2021, 2022, there's always a chance that something could happen unexpectedly. And this is why people may prefer the security of a fixed rate. Now, what about my record as forecasting interest rates? Well, 2 years ago, I chose a 2-year fixed rate mortgage at a very low rate. And it was a much better choice than a tracker mortgage, and it saved me a lot of money. But of course, if I'd been really wise, I would have taken advantage of the ultra low interest rates and taken out a 10-year fixed rate mortgage. And if I'd done that, I'd be really pleased with myself. But the truth is that in 2021, I didn't really think too much about it, which might sound surprising given I'm an economist and I think about this a lot. But I just got so used to low interest rates that I didn't foresee something like what happened in 2022. And to some extent, I regret it now. In 2020, I took out a second mortgage for an extension and wisely, or perhaps luckily, took out a 5-year fixed rate on that extra $35,000. So that was a good choice. Just a shame I didn't get a 10-year fix too. So my past regret is not taking out a longer fixed rate mortgage. But now I'm going to gamble and hope that interest rates fall. So I could definitely lose out and face higher mortgage payments. But on the balance of probabilities, I think it's more likely interest rates will fall, which is why I want a tracker at the moment. The final point is that if I have any surplus savings, I'm going to try and use it to reduce the capital balance, because at the moment it's one of the best forms of savings. In 2005, I took out a 43-year mortgage, and the first 5 years was interest rate only, so I've done very little to reduce the capital. But now I'm no longer a racing cyclist, spending £6,000 a year on bicycles. I'm able to put some money towards repaying the capital balance, which helps reduce interest rate costs. So if you're in a position to do that, it's definitely a good use of savings. So of course, this is not financial advice, but I hope that it helps inform you on the decision that I've come to. If you're interested in the housing market, check out this video on the latest prospects for house prices.